All right, traders, we've got a busy week ahead with a few events that could move the needle. I think in the current macro context, it's best to try and really limit the noise as much as possible and just focus on the really big events, which for the week ahead is, of course, the FOMC decision, the Bank of England decision, and we also have Canada's employment report coming up on Friday. So let's walk through what matters and why, starting with the FOMC. The FOMC on Wednesday is definitely going to be the main event for the week, especially after Friday's jobs report that we got. I mean, in terms of market expectations, we just quickly bring that up here for a second. We can see that short-term interest rate futures are currently expecting the bank to leave rates unchanged, implying a 97% probability of a hold from the bank. What does that mean for us as short-term traders? It means that the rate decision itself won't really matter for markets, but what Powell and obviously the statement has to say about rates going forward, that will be the main focus point. That's going to be the most important thing. I mean, recently Powell has stuck to his wait and see script, and right now it looks likely that that script continues this week. I mean, let's take a look at some of the data here, right? Let's start with inflation. Inflation, even though we had that push to the downside in the March data, inflation at these levels still remains way too elevated for the Fed to get excited about cutting. Yes, we did see that move lower in March, but the Fed isn't just looking at the here and the now, right? If you take a look at things like the prices paid components for both the ISM manufacturing and services, that is showing us upside risk for prices in the months ahead, right? It's these types of measures that they are looking at, which is getting them a little bit cautious about, calling victory on inflation and just cutting rates as President Trump wants them to. When you look at data like this, there's reason for you to be a little bit more careful. Apart from that, we had the core PCE data last week printing at 3.5%, way above where the bank would want to see that to feel comfortable potentially cutting rates. Apart from that, consumer-related inflation expectations have jolted to multi-decade highs recently. And the reason why these things are important for the Fed, remember, when it comes to consumer-related inflation expectations, it has historically had a very bad track record for predicting where inflation will go. But what is problematic for the Fed about these numbers is that when you have this size of a shift in terms of price expectations for consumers, theoretically, that should impact consumer spending habits. And that is what the Fed is really concerned about here, is that how will this perceived expectation of higher inflation, how is it going to impact spending and saving and investment going forward? That is the main focus and concern for them right now. Apart from that, if you take a look at market-based measures of inflation expectations, looking at the 5 and the 10-year, they are still elevated and above the bank's 2% target, much higher than the levels we saw back in August, of course, where the Fed wanted to cut rates a little bit more aggressively. Also keep in mind that, the US dollar, if you take a look at price action recently, the dollar has obviously seen quite a lot of downside in recent months. And remember, a weaker currency has the potential by itself to spur some upside in inflation as well. So there's lots of reasons on the inflation side for the Fed to adopt a wait and see approach coming into this week's decision. Furthermore, if we take a look at Friday's jobs data that we had, another solid print for jobs, right? 177,000. Now, yes, there was a punchy revision lower in the prior data, but at 177, the labor market is far from cracking at this stage, right? Now, yes, there are some that argue the new cycle high that we had. Let me just show you guys here. The new cycle high that we printed for the continued jobless claims, that is a reason to be cautious. And yes, I agree. And yes, this is of course something we will be paying attention to, but it's also worth noting, just take a look at how noisy this data set has been. It's hardly a definitive thing to say, oh yes, the labor market is now finally cracking. We might be lower in this week's print coming up. So of course, this is something we are watching. And yes, of course, this is something we need to be cautious of. But this in itself isn't going to be enough for the Fed to suddenly say, oh yeah, okay, fine, let's just cut rates, right? This just isn't as negative. Now, what about growth, right? Surely the very negative print that we had for growth last week should be enough for them to cut rates. I mean, negative 0.3%. Look, was it a bad number? Yes, it was a bad number. But most of that downside right, was driven by increased imports as businesses were trying to front run tariffs in the first quarter. So yes, it was a bad print, and yes, this is certainly something the Fed will mention, and they will obviously look at this data, but it's not all that bad in that sense when you consider that it's all just basically front loading. So with all of that in mind, I think it's more likely that Powell sticks to the wait and see script and basically reaffirm that they are in no rush right now to be looking to cut rates. That said, if you take a look at the markets are still holding on to hopes towards the back end of the year that we still get another 3 potential cuts by the Fed this year. Now, why is that important? It's important because if the markets are still pricing in a fair chance of decent cuts throughout this year, and at the same time you are looking at positioning data for things like the US dollar, which is still very stretched to the downside, right? That sets up a potential clean risk to reward play for the week ahead. If Powell comes in more hawkish than what the markets are anticipating, and he doesn't play ball with the doves at all, and potentially even pushes back on cuts that are priced towards the end of the year, that could create a decent bouncing opportunity for the likes of the US dollar. It's not that the Fed needs to hold rates here forever. It's just that they might not be ready to pivot as quickly as the markets would like them to, or at least as President Trump would like them to, right? And in that case, you've got the potential for a little bit of a short-term short squeeze to develop in the US dollar. I mean, if you take a look at the weekly implied volatility measures for the dollar index, we can see there's a fair bit of upside potential here, back up towards that resistance prior support going back to the 3rd of April. And if you consider that with the things like the euro dollar hasn't been able to convincingly or sustainably stay above 1 week price momentum for the past 3 weeks. So it does show us that a little bit of buyer fatigue has set in here for the euro dollar, which again could be bad news for euro dollar bears, but good news for dollar bulls here. So that's something worth watching. Now, if that happens, that could also be bad news for the equity rally that we've seen recently. When you look at equities, where we are in proximity to the 200-day moving average is getting a few of us, from an analyst point of view, a little bit uneasy at the moment, because it has some starking similarities to what happened back in 2022. Back in 2022, let's just quickly zoom out there. Let's take a look at the NASDAQ first. Back in the 2022 bear market, we had very similar occasions where we had that big push to the downside, over 20%, and then a close to 20% rally before we rejected from the 200-day moving average. There was a little bit of a false hope there, right? We breached above the 200. Everybody thought, okay, fine, the coast is clear. We're above the 200. We are so back, and then suddenly we broke below and we made fresh lows after that. So this type of setup looks eerily familiar to what we're seeing right now with the NASDAQ as well, right? Breaking below, down 26%, rallying up another 22. Could this be another false break that pushes us lower? Obviously, if the Fed comes in hawkish enough, that could be a short-term catalyst that creates that possible setup. It's not just the NASDAQ, same story there for the S&P as well. If we go back to 2022, we had that break lower, break above the 200. Everybody thought the coast is clear, broke back below it. And look at that retest we had a couple of months later, again from the 200 back in August 2022. So this is important this week because equities have had a fantastic rally. And you guys know me, I am 99% of the time, I am a US equity bull, right? I always see the optimism when it comes to US equities, but this is something that is making me a little bit uncomfortable right now. It's not something that is making me want to short equities, at least not yet. But if Powell comes in hawkish enough, or US data this week, like the claims data does surprise massively higher again, and we do get some cracks showing up, then obviously that could be levels worth leaning back into for equities in the short term, because it is starting to look, uncomfortably similar to what we had back in 2022. So that's definitely something worth keeping in mind. So it's a tough call right now whether, this is another setup like 2022, whether we are officially in a bear market and this is just the bounce, or whether this has been the pushback and now we just print to fresh all-time highs. It's Very tough to make that call right now. But obviously, the Fed's direction on rates this week could certainly provide some short-term answers to the market's questions on that front. So the next one coming up will be the Bank of England on Thursday. Now, this one is going to be less exciting than the FOMC for sure. I mean, in terms of market expectations, the markets are pretty sure that the Bank of England follows through with another cut. This month, we can see that 24 basis points is very close to priced in. So that's about a 95% probability that we get a cut. That means, just like the Fed, the rate decision itself won't really matter or be that important, but rather what the bank's guidance is regarding rates going forward. I mean, previously, the bank guided markets to say that they see themselves cutting rates once per quarter this year. And if you look at what rates markets are pricing in, that is pretty much where money markets are priced, or money market bets are sitting right now. So there won't be a big surprise if they just come out and they do exactly what they said they would. Now, some argue, or have been arguing that the growth outlook for the UK economy is weak enough for the bank to increase their dovish guidance. But I mean, to be fair, if we look at things like the City Economic Surprise Index, which tracks surprises in economic data, the economic data hasn't been nearly as bad as some have been touting over the past few weeks, right? Is there stresses for the economy? Absolutely, but it's not really reflected in the data as much right now. Furthermore, with all of the nonsense about the accuracy of some UK data sets right now, I wouldn't put too much emphasis on that, because the data could be out by a mile at this stage, right? In either direction, either good or bad. We just really don't know. But the biggest reason why I think a dovish pivot feels unlikely is just because of inflation, right? If we take a look at UK inflation, whether you look at core, whether you look at headline, whether you look at services or even wages, inflation is just way too high right now for the bank to get excited about cutting rates more, right? It's just, the bank can't afford going too dovish too quick right now, because inflation is just too high. So the tone of the message from the bank will be watched closely, but I doubt whether we get any new information. Obviously, if they either push back against the rate cuts that are already priced in by the markets, or if they potentially increase their dovish language and say that more cuts are needed, then obviously those will be tradable opportunities, but I think it's unlikely we get it in the week ahead. Let's just assume for a second we do get either one of those outcomes. If they do push for lesser cuts than what the markets have priced in, I do like the odds of further downside for euro sterling. We've had a nice rejection from that highs, a nice trade that set up a couple of weeks ago, as you guys know. We broke below key support around that 85.18, 18.15 level, and we're currently just struggling to break back above that. So if we get a Bank of England, which sounds a little bit more hawkish, then that can obviously create some further downside pressure for the likes of euro sterling. And if the bank does come out and they are more dovish as some are expecting them to be, then obviously pound dollar downside could be interesting, especially if the Fed comes out and they are a little bit more hawkish than what the markets are anticipating. So that is what I'll be watching for in terms of the Bank of England. But again, not nearly as excited about that one as I am for the FOMC. Now, finally, the one that I think we need to also watch closely this week will be Friday's jobs data coming up for Canada. This one could be sneakily important for the CAD, because if you take a look at what's happened under the radar over the course of the last few weeks for the CAD has actually gone from massively stretched short to stretched long in a very short space of time, as a lot of players have obviously unwound the tariff hedges that was put in place for the CAD from a couple of months ago. Now that has seen dollar CAD, obviously alongside dollar weakness, push lower quite considerably in recent weeks, and that sets up an interesting area here for the dollar CAD going into that data, right? Because the last few BOC communications, the bank have basically acknowledged that growth is slowing and trade tensions are hitting business confidence massively right now. So if this jobs number comes in as soft as the prior ones that we had, it could give dollar CAD bulls a reason to get back in on the long side from these lows. I mean, a big miss here could also open up the door for a possible shift in interest rate expectations, because if you take a look at where we're sitting right now for the BOC, the markets are basically split between a cut and a hold going into that June meeting. We're basically at a 50-50. So with the 50-50 odds in play, I mean, it can go either way. But if we see a big miss on top of growth concerns, on top of investment concerns, tariff concerns, all of these things, then I think that could provide an opportunity for some short-term upside for the dollar CAD. Again, assuming the FOMC comes in a bit more hawkish as well. Key levels that I'll be watching there for the dollar CAD. Obviously, key resistance will be that 139 psychological level. Key area here for us to watch for the week ahead. And let's just see where we're tracking in terms of weekly. Weekly implied volatility is sitting fairly close to that 139.50, which is also the high going back to the 15th of April. So nice confidence there in terms of levels to aim for if we get that bad print. The other risk that we just need to keep in mind for the CAD this week is that apparently there's going to be a meeting between the new Canadian PM Carney and Donald Trump this week, and obviously they're going to talk tariffs. So if those two manage to scrap a deal together, then obviously all bets are off in the short term for dollar CAD upside. That could see dollar CAD drifting even lower from here, of course. So do make sure to check that out. But if they walk away without a deal, and then we also on top of that get bad jobs numbers, it could set up for a decent move higher in the dollar CAD, or a move lower, if you will, in the Canadian dollar in the short term. Now, in terms of other risks, looks we've got other risks coming up as well. Not that I'm too excited about them. We've got Swiss CPI coming up on Monday. We've got the ISM services coming up as well. That's pretty much going to be old news after last week's data. We've got some employment data coming up for New Zealand as well. Obviously, we've got the weekly claims data coming up, which we'll be keeping a close look at. And we've got a whole truckload of Fed speakers coming up on Friday, which will obviously be potentially market moving as well. But out of all of these, I think the FOMC and the Canadian jobs data is definitely the ones that I'll be paying the most attention to in terms of bang for our buck. We also have earnings season continuing this week, but very, very few big weighted names here. I think the most interesting one could be the likes of Walt Disney, maybe Monster as well, obviously looking at consumer health. But, you know, let's face it, these names have such a low weighting. I doubt whether it'll have a big impact in the indices, broadly speaking. So main focus, like I said, FOMC, then Canadian jobs data, and then maybe the Bank of England if they do manage to surprise the market. So with that said, as always, have a fantastic week ahead. As always, any questions, don't hesitate to let me know. Stay nimble and trade safe.